Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I want to talk about the euro. If you're a regular blogger or have been one in the past, you have a peer in the European Central Bank president. President Lagarde does not blog often, but yesterday she did use the ECB's blogging platform to signal that the central bank was set to end negative interest rates within months. For the euro, of course, this could signal an important turning point. Now, first, a little context. In our view, we continue to be in a market where expectations of interest rates and the differential across different central banks remains a major driver of currency markets. This is, of course, what drove the US dollar index close to 20-year highs as the Fed pushed interest rate expectations higher against what was very little or no change in Europe or Japan. Now, this last point, of course, is what could be changing. Even as expectations in the US of Fed rate hike expectations start to top out, they are now rising in Europe. Now, one key trigger, as elsewhere, is inflation. This rose to 7.4% in April, and while much more of this number in Europe is driven by energy price shocks compared to the US, one could argue that persistently high inflation numbers can start to push inflation expectations much higher, which is where demand-led inflation problems can start to get entrenched. Now, the ECB does, however, face two additional challenges when considering raising rates. The first is that economic growth itself remains weak. While yesterday's IFO Business Sentiment Survey was a positive surprise, the EU continues to face an unenviable mix of shocks that push inflation up and growth down. The Ukraine conflict and resulting spike in energy prices is one such challenge, but supply chain bottlenecks and lockdown-led demand weakness in China remain other challenges to growth. This likely explains why several ECB policymakers favor a gradual approach rather than a sharp rise in rates. The second is the risk rising rates present for Italian and other peripheral European country funding costs. Expectations of a kickoff of ECB rate hiking cycle have already pushed the gap between German and Italian government bond yields to about 200 basis points. Now, as ECB rates rise, this spread is at risk of widening further and at some point potentially creating funding challenges for more indebted sovereigns. Having said that, we do remain some distance from the 300 basis point spread last seen in late 2018, or indeed the 500 basis points or so last seen in late 2011 during the crisis period. Now, all of this is most probably why Lagarde was at pains to emphasize gradualism on the rate hike cycle, that the Eurozone was, quote, not facing a straightforward situation of excessive demand, and that rate hikes were really about bringing policy rates closer to neutral, which the ECB estimated to be between 1 to 2%. Now, in our view, we see rising rates as positive for the euro and also incidentally negative for the dollar index, given the euro's large weight there. The euro-US dollar pair made an interesting move after Lagarde's blog post, breaking above key resistance at 1.064. From a purely technical standpoint, in our view, the outlook has turned bullish on a short 1 month ahead horizon. The next near-term resistance sits at 1.0785, just above the 50-day moving average, and any break above that could see the pair accelerate and test April highs of 1.092. So overall, an increasingly a time to be long the euro-dollar rather than looking at it as a short-term funding currency, something we'll be watching closely in the coming weeks and months. But we'll take a pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening. Wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.